In the first 18 months of the 2022 bear market, the global technology sector shed $5.6 trillion in combined market value, more than the entire annual GDP of Japan. And most retail investors did not feel the bottom even after losing half their portfolios. It is not a correction. It is a prolonged collapse in asset prices that 20% or more from recent highs persist. And far from being a stock market curiosity, it is a force that reaches your pension, your job, your rent, and your grocery bill long before the financial press admits what is happening. Bear markets dismantle careers, erase years of savings built in good faith, and rewire entire industries, while the daytime commentary pretends the sun is barely behind a cloud. Recognizing that you are living inside one changes how you protect your money and your future. To understand what that means, imagine a young couple in Berlin who overinvested in growth funds during the crypto boom, only to see 40% of their savings vanish within a year. Meanwhile, entire economies tied to tech exports, such as South Korea, where semiconductor giants like Samsung lost almost a third of their valuation, faced cascading layoffs that stretched from factory floors to graduate recruitment. In the United States, once celebrated crypto lenders Celsius and BlockFi filed bankruptcy, freezing billions in customer accounts and signaling that reckless yields from the bull run had finally collapsed. These cascades are all connected to the same global liquidity withdrawal, a toxic stew of aggressive rate hikes, corporate earnings downgrades, and consumer confidence cratering. When the US dollar strengthens relentlessly, emerging markets that borrowed cheaply in dollars get crushed, with Sri Lanka's default becoming a textbook case of a sovereign implosion triggered by capital flight. Bear markets are not just numbers on a screen. They are a chain reaction that starts in central bank boardrooms and ends in shuttered storefronts and canceled health insurance. A bear market is a sustained period where broad asset indices fall 20% or more from their peaks, often accompanied by widespread pessimism and economic contraction. Unlike a fleeting correction, a bear market can last months or even years, grinding down valuations through a brutal combination of falling earnings, rising risk aversion, and forced selling. The classic anatomy begins with a trigger, such as a sharp interest rate hike cycle, a sovereign debt crisis, or a speculative bubble popping, and then feeds on itself as margin calls, layoffs, and credit crunches amplify the initial shock. The 2000 dot-com bust saw the Nasdaq lose almost 80% over 2.5 years, while the 2008 financial crisis erased trillions in household wealth and took nearly a decade for employment to recover. In both cases, the psychological shift from greed to fear became a self-fulfilling prophecy, as investors who once threw money at any ticker symbol suddenly demanded cash and safety above all else. What it actually feels like inside a bear market is a slow erosion of certainty. Your portfolio drops 10%, you tell yourself it is temporary, then it drops another 20%, and the financial news starts using words like capitulation. Friends who bragged about their crypto gains go quiet. LinkedIn fills with sudden, open-to-work posts, and the once confident analysts on television begin hedging every statement with uncertain times. The emotional cycle often follows a predictable path. Denial, then anxiety, then a desperate attempt to catch the falling knife, and finally a numb resignation where you stop checking your brokerage app. That resignation phase is historically when the real bargains appear, but it is also when most retail investors have already sold at a loss, locking in damage they never recover from. The psychological toll is not just about money. It rewires how you see risk, often making you too cautious to re-enter the market even when the cycle turns. Surviving a bear market requires a shift from offense to defense without abandoning the game entirely. The first rule is to extend your time horizon and stop measuring performance in days or weeks. If you need the money within 3 years, it should never have been in equities during a bull run, let alone a bear one. The second is to stress test your personal balance sheet. Do you have an emergency fund covering 6 to 12 months of expenses? And are you carrying high-interest debt that could become unmanageable if your income drops? The third is to resist the urge to go all in on safe assets like long-duration bonds, which can crash just as stocks do when rates spike. Instead, diversification across uncorrelated assets, including commodities, inflation-protected securities, and even a small allocation to uncorrelated strategies like managed futures, can smooth the ride. Historically, those who dollar cost averaged into broad indices during the worst months of 2008 or 2020 came out ahead, while those who tried to time the bottom often missed the sharpest rebounds. The mainstream narrative often frames bear markets as something to be waited out, as if they are a temporary storm. In reality, they are the mechanism by which markets purge excess, reset valuations, and transfer wealth from the leverage to the patient. The companies that survive are often the ones that cut fat, refocus on core strengths, and quietly acquire distressed competitors. For individuals, the bear market is a brutal but effective teacher. It exposes the fragility of concentrated bets, the danger of following influencers who have never lived through a real downturn, and the importance of building a financial life that can withstand multiple shocks. The real risk is not the bear market itself. It is entering one without a plan, without cash reserves, and without the emotional discipline to avoid panic selling. Those who understand this do not just survive. They position themselves to buy what others are terrified to touch, and that is where the next generation of wealth is quietly built. The next time you hear someone say, "The market always comes back," remember that it does not come back for everyone. It comes back for those who still have capital, clarity, and the nerve to act when the headlines are at their bleakest.